Good afternoon, everyone, and thank you for being here. Before I dive into today's topic, I thought I would start with a quick introduction. So, like many of you, I'm an expat here living in Switzerland. I moved from the UK almost 10 years ago now from Manchester. And over the years, I've lived in France as a frontalier, Geneva, Fribourg, and Canton Valais. And outside of work, we spend most of our time in the mountains, trail running, hiking, and enjoying the amazing food that Switzerland and its surrounding countries have to offer. Switzerland will always hold a special place in my heart because it's where I met my first true love. As you can see on the screen now, my golden retriever, Luna. I'm only joking. The truth is, I actually met Anya, my wife, on the first day I arrived in Geneva back in 2017. Ironically, we were both working for rival wealth management companies at the time, so as close to a Romeo Juliet story the finance world will ever probably see. And as the saying goes, behind every good man is a great woman, and it was Anya who encouraged me to set up on my own. And in 2020, we incorporated Rosbotham Finance with one simple goal in mind, which was to bring true independent financial planning to expats here in Switzerland. So Anya is the operations director. She's also the creative mind behind the visuals you'll see today, and also all of the visuals on the website and my LinkedIn posts, for example. So that's a little about myself and Rosbotham Finance and how we began. Let's move on to what we do and who we help. So we predominantly work with expats here living in Switzerland, helping them bring order and clarity to their finances. And what I would say is financial planning isn't just one thing. It covers a wide range of areas that all connect. And for expats, it's surprising how many moving parts we actually have. One thing I will say is many people seem to think that financial planning is strictly on getting the best investment returns, but true financial planning is much broader. As you can see on the screen, it includes pensions, taxes, estate planning, cash flow forecasting, and relocation, repatriation. And ultimately, what you're thinking about is how they all tie into your long term goals. Over the past decade, one thing I've found is that all roads lead to one destination, retirement planning. And some clients tell me that they never want to retire, which is absolutely fine. But in the reality is most people I meet, often without even realizing, are saving and investing for their future. If you think about mandatory pensions contributions. And retirement planning is probably the most rewarding part of my job. And we'll actually be holding separate seminars and presentations on that later this year, which will keep you posted. And in fact, over the past couple of years, it's been part of our mission as a company to reconnect with clients once they've retired. So rather than just doing Zoom calls, what we want to see is how the plans we built together are supporting their lifestyle. What started with local rounds of golf has grown into hikes in Austria, France. We've had tapas in the south of Spain, lunch in Barcelona, and even a couple of visits to new local pubs in the UK. So, with that context in mind, today's focus will be on two of the most important elements of a financial plan: pensions and investments, and more specifically, what you as an expat in Switzerland should be thinking about. So, most people we meet with will have done some form of planning, whether they know it or not. So, if you think about the company seminars you may have attended, some self learning by browsing online, or even chatting with your colleagues, this usually starts with pensions. And what I will do today is I will give you some examples of what I would categorize as basic, medium, and high level. And we'll start with the Swiss pension system. So it's built around three pillars. Very simply put, the first pillar is your state pension, second pillar is your company pension, and the third pillar is an additional pension that is usually funded by surplus savings, which comes with some tax advantages. Now, most expats will already be contributing to the first two pillars if you are employed. So the first pillar deducted before you even receive it, and you probably won't even get a statement on this until you're close to retirement, or if you're thinking of leaving Switzerland and you just want to know what you have in it. The second pillar is again automatically deducted from your salary, but you will receive a statement once a year at least from your company. And it's the second pillar which is a pretty powerful vehicle for expats and will be a key part of your overall financial planning. So, what would be classed as medium level planning? So, I would say medium level planning starts to get a little bit more complex. For example, the use of your second pillar can actually help you purchase a property in Switzerland. This is sometimes referred to as pledging. So, you pledge part of your pension towards the deposit of a house. Now, this can make sense, but it also reduces what's left in your pension, and the decision can have a real impact on your well later in life when it comes to retirement. But the interesting part is, and I think it's how humans are we're driven, we're told we're all desperate to get on the property ladder, and more often than not, people rush into this decision with short-term thinking. Another example is for the voluntary contributions. So in Switzerland, you can actually make top up payments to your second pillar. So if we think back to the three pillar system, let's say you've done your additional pension as well in your 3A, and at the end of the year, you receive a bonus, you're wondering what to do with it. There is the option where you can, if you have space in your second pillar pension, you can make a contribution that is tax efficient. There is one very key rule which you just need to look into, and it's the 3-year rule. So before withdrawing those funds, if let's say you've made a voluntary contribution, the period that has to pass is 3 years before you potentially withdraw that pension in retirement. So for people nearing retirement or thinking of relocating, the timing is really significant. And these details are exactly where advice can save you money and headaches in the long run. And another aspect just to think about, which not many people are aware of, but did you know that if you use your second pillar pension as part of the deposit for a house purchase, any future voluntary buybacks into your pension won't be tax efficient until that pledge has been repaid? So to summarize, basic level pension planning, it's pretty much automatically done. You're contributing from your salary to your second pillar. There is the option where we often get asked, can I increase my contributions? If your employer asks you whether you can do that and you can afford it, it's sometimes a good idea. But more often than not, it's already set up in a default position and you don't have to do anything. Medium level planning, a lot of people just go ahead and make the decision themselves. I would definitely speak with an advisor if you were thinking about using your Swiss pension for a property purchase. And then voluntary contributions, a great way of building wealth in Switzerland. Just remember, anything that's tax efficient, you're usually deferring until later in life, which is what you do with a pension. And just remember 3-year rule. So moving on to what I would say is more high level planning. And this is where I would encourage people to speak to financial planners, financial advisors. When it comes to your second pillar, when you look at the statement, you've got some big decisions to make. And the first one is usually, do you take a lump sum or do you take an income? And the best way to look at that is understanding the impact on your retirement income. How does it complement against other pensions or investments you might have? You have to, it's $1 million question that I ask expats, where do you think you'll retire? The majority don't know until they're made redundant or they offered early retirement. So don't worry if you're concerned about that. But it's important to know how you are taxed in Switzerland, and even more important to know how pensions are taxed, especially Swiss pensions in the new location that you're planning on going. Also, as well, redundancy before the age of 58. 58 is a key age in Switzerland because if you have a look at your pension statement, especially for expats, I don't like to be the bearer of bad news, but more often than not, we are very expensive to employers. And if you look around the office, it's more often than not those above 50 or around the 58 mark that will get offered redundancy, the golden handshake, so to speak. And this can have a significant impact on how you're planning on taking your pension. Because if you're made redundant, say at age 55, the chances are you won't be able to remain in your Swiss pension and you'll have to move your pension to something called a vested benefits, which then limits how you access your pension, probably just to a lump sum. Now, there are some vested benefits out there that say they will do an income, but conversion rates aren't great. So it is key to have a good understanding of your lump sum income, how that's all impacted. So that's when you look at the Swiss pension system. What you need to then think about on a high level is how that complements the rest of your plan. If you're thinking about estate and inheritance tax planning, do you know the cross-border rules? What about currency exposure, Swiss pensions and Swiss francs? How is it looking against the euro, the pound, the US dollar? And then also the timing of withdrawals. So sequencing between pensions, investments, and other income sources. So for many expats in Switzerland, the second pillar is by far one of the largest pension assets you will have. And if you're unsure about any of the technical details of how it works, and more importantly, how it will impact your next steps in your plan, it's worth seeking independent advice at this stage. Also, international pensions, it's worth noting. So, you've worked here in Switzerland and you've built up your Swiss pensions, but for many expats, that's only part of the picture. The chances are you've also worked in another country before moving here, and that means you may have multiple pension pots across different systems. And understanding how they fit together from a taxation portability point is crucial to your overall planning. As you can see on the screen, probably the most common question I get asked is, can I transfer my pension to Switzerland? And the short answer is no. It's very difficult, almost impossible, to consolidate international pensions. And then you have to have a little think about how that impacts your plan. So, on the positive side, you've had the opportunity to work in different countries and build valuable benefits. On the downside, it adds another layer of planning and one that you just can't simply ignore. And the reason being, not all pensions can be accessed at the same age. So you need to know how and when each pension becomes available. You need to understand how that one is tax treated, especially is there a double taxation agreement in place? If not, then who taxes me basically? And then you have to understand whether you have an income, a lump sum. So, for example, UK pensions can provide a 25% tax-free lump sum, the rest can be taken as income. Or is one method more tax efficient than the other? There's multiple questions that have multiple knock-on effects to your overall financial planning. And I've put together an impact or a slide here, which is a chart that basically just explains. So you'll see across the top, there's a dashed line that shows somebody who is looking for fixed annual living expenses of 50,000 Swiss francs. And then you have the blue line, which shows pension income starting from 20,000 Swiss francs at the age of 62. For example, he's taken his income from his second pillar, it's paying 20,000 a year at 62, but then his French pension only kicks in at 64, and you can see where the blue line curves out. And then finally at 65, the Swiss first pillar ABS kicks in, and eventually he manages to achieve his 50,000 a year that he needs. But what you can see here is just the red shaded area highlights the income shortfall, showing that because pensions can't all be accessed at the same time, there's a gap in early retirement. And you just need to be aware of this, because the last thing you want to do is retire and not be able to afford to live, which is where pension planning is key. And lastly, we have pension drawdown. So in retirement, drawdown usually comes from two sources: pensions and investments. So your pensions may provide a base level of income, while investments can be used to top up or bridge gaps, like I mentioned in the previous illustration. Now, the challenge is that the sources often become available at different ages and are taxed in different ways. That's why having a clear strategy is essential. So you know which pot to draw down from when and how much, ensuring that your income is both sustainable and, more importantly, tax efficient over the long term. For me, this is where an independent financial planner can add real value. We help you understand when each pension becomes available, which one to draw from first, and by working closely with clients, we build a retirement cash flow strategy or drawdown plan that ensures your income is sustainable, tax efficient, and we'll stress test that against things like inflation as well. One of the common mistakes that we see from DIY investors or do-it-yourself financial planners is they misjudge their cash flow. So that moves us on to the second part of the presentation, which is understanding investments. More importantly, what should you be thinking about as an expat here in Switzerland if you're thinking about making a new investment or you're looking to review an existing investment that you may have? And we'll start with currency risk. So, as an expat in Switzerland, currency is a pretty big deal at the moment. So, Swiss franc is very strong against other currencies. And let's put it into perspective. So, if you're earning in Swiss francs, you're investing globally, and then you're eventually retiring in a different currency altogether, it's quite a complex, a little bit of a headache, some would say, when you're thinking about how do you allocate funds to which currency and so forth. Exchange rates shift all the time, and this can have an impact on your real rate of return and purchasing power in the future. So it's why we always say it's important to think about not just where your money is now, but where you'll ultimately be spending that in retirement. And the easiest way I can illustrate that is it from an investment point of view is let's have a look at the chart on the screen now, because this is something many expats in Switzerland overlook. So imagine if you have an advisor and he tells you that the fund in your portfolio has made great returns, but when you check your bank account, it doesn't look that way. So from the simple example on the screen, let's say back in 2022, if you were to invest 100,000 Swiss francs in a fund that simply tracks the S&P 500. So in 2022, the exchange rate was one Swiss franc to $1. So fast forward 3 years, that fund tracking the S&P 500 has done really well. It's returned between 17 and 19% over that 3-year period. And on paper, your investment is now worth between $117,000 to $119,000, which looks great. But here's the catch. So the dollar has actually weakened today. So $1 today is worth 0.8 Swiss francs. So when you come to convert that back, you actually only receive around 94 to 95,000 Swiss francs. So despite a strong market return on the fund, you've actually lost money in real terms because your underlying performance is still in Swiss franc. So the lesson here is be careful what performance numbers you see online or hear from friends, colleagues, even advisors. They might be quoting returns in their own currency, not yours. So many expats in Switzerland will receive stock options or RSUs from their employer as part of their package, a salary package. And this can be a fantastic opportunity to build wealth, but it also means that a lot of your financial future is tied into one company. This is often a topic where it can be quite a difficult conversation for an advisor who's working with a client who perhaps has a confirmation bias, let's say, towards their company. And more often than not, we see many people who hold on to their stock options too long. What is important, I would say, is to have a stock options strategy. And what do we mean by that? Well, you have to understand how those stock options or RSUs are taxed in Switzerland. And then you have to think about how much are you actually comfortable holding as part of your overall portfolio. One of the best questions that I would ask somebody if they're holding a significant amount of stock options or RSUs from their company is, if I was to give you 100,000 Swiss francs today, would you invest it in that one stock? More often than not, the answer is no. And then surely that means, should you be looking at diversification? It's not as simple as that. There's obviously a lot of conversations that go on during this meeting. But the reason I bring this topic up is because the number one tip I have is don't just hold stock options without a plan. And you can see on the screen here, so I've had conversations with clients who've worked with Biogen and Nestle, 2 5-year charts you can see on the screen here. Biogen down from its peaks by around 48% over the 5-year period, and even Nestle is down 34% over that 5-year period. And what you find is people will then hold on to those stock options, presuming that the market will bounce back. And unfortunately, in life, there are no guarantees. We have death and taxes. And the bottom chart, which you can see, is actually the one from Nokia. Now, its all-time chart, you can see there, it says it's up 292%. However, if you look at Nokia at the peak in 2000, and then it just went on a trajectory down, there were so many of their employees who were left holding this stock, and they were waiting for a bounce back, which eventually came, as you can see in 2008, but it never quite reached the peaks of the previous high point. And people presume that it will reach that high point, and then lo and behold, that company has never bounced back. So sometimes holding stock options can actually be deemed more risky. And I meet many clients who've worked with many companies that are still holding stock options from 15, 20 years ago because they never had a strategy in place. Investment products in Switzerland. So when we look at the Swiss market, there are certain investment products that are very common. Things like structured products, we see a lot of insurance-linked investments, and then bank-managed portfolios. And some of these can be suitable, but many of them come with high costs or even limited flexibility and even big surrender penalties. Having worked in the industry now for nearly a decade in Switzerland, one of the most prevalent things that we still see are things like savings plans. And a savings plan is where an advisor will sign you up to an investment contract whereby you say you pay 2,000 Swiss francs per month for the next 15 years. They may tell you that it's flexible, you can pause it when you like, but the devil is in the detail. They come with high costs due to commissions being paid to an advisor, and more often than not, they come with surrender penalties if you want to exit the plan. If you've ever been offered or you're considering a savings plan, I would maybe ask your advisor something like, well, is there an investment platform available that I can invest in the same things? Because with an investment platform, you simply open up an account and you add money as and when you like, and then you can take it off without any penalties. So if you already have one of these products or you're considering one, just remember it's important to review carefully the finer details and just make sure it actually fits in with your longer term goals. Okay, so the next slide or the last slide of this part of the presentation, we're going to look at different investment strategies. And to simplify, you have active management and then you have passive strategy. So knowing which investment strategy is for you is key. So active management means paying a manager or advisor, fund manager to try and beat the market. And in my opinion, which is also backed by quite a lot of research, over the long term, most managers don't consistently deliver above market returns, and also the higher fees can eat into your growth. Whereas passive investing, on the other hand, keeps costs low by simply tracking the market, and it has proven to be a reliable way to build wealth over time. So, for most expats, a clear, low cost strategy provides transparency, diversification, and peace of mind. And again, if you're thinking about making an investment or you already have an investment with a bank, an advisor, maybe you have one of the products I mentioned above, I think it's really beneficial to review what you have sometimes. So, as we close, I wanted to focus on why Rosbotham Finance is different and why that matters for you as an expat. And I always start by asking the question, what's the difference between a financial advisor and a financial planner? Now, there's no official rule book on titles. People call themselves financial advisors, financial planners, wealth managers, investment consultants, retirement specialists. The real difference is not in the name, it's in the process. And what I mean by that is if somebody's offering you a free financial review without charging a fee, it's worth asking, will that advice be truly independent, or is there already a product they have in mind that they want to sell you? So you also have tied advisors. So UBS, going to give you a UBS fund. Swiss Life most likely recommend the Swiss Life product. It's just how it works. In my opinion, though, I would say a financial advisor in many cases acts as a sales agent, whereas a financial planner, on the other hand, he takes time to bring everything together. It's not about selling a product, it's about understanding your goals, your objectives, your experiences, and then designing a plan that fits into your unique circumstances. Everybody's plan is different, so that's why we take the time at Rosbotham Finance to understand what it is that drives you, where you're going next, and how best to position yourself. So when we talk about value, I'll bring you back to the slide I showed you at the start, what many people think financial planning is versus what it truly is. And on the screen now you can see a couple of testimonials. And after everything we've covered today, pensions, international complexities, investments, the real question is, what value do you place on peace of mind? And that's what our clients tell us that we give them. And as I mentioned, you'll see some of the words on the screen now. You can also visit my LinkedIn page and you'll see many testimonials from the clients I've worked with over the years. And I would just like to say a big thank you for your time and attention today. I hope it's given you some useful insight into what we do, how we help. And if any of the points we've covered raise questions for you personally, I'd be very happy to continue the conversation in private. You can reach me directly on LinkedIn, or you can message me on email. But at the end of the day, at Rosbotham Finance, our role is to help expats like you bring clarity and peace of mind to what can feel often like a complicated financial journey. So please don't hesitate to reach out. Sometimes just starting the conversation makes a difference. So thank you once again, and I look forward to hearing from you all.